The home building market in America is a complete contrast to Australia. So in Australia, it's cheaper to rent, it's very expensive to buy a home, and the mortgage repayments are sucking up more and more of people's income, and depending on which measure you use, it's potentially 35 or 40% even, which is very high by historical standards. And you've also got more supply coming on, and people are starting to get worried about an oversupply of apartments in particular. In the US, there's an annual deficit of homes being built. The long-term average is about 1.4 million. Some have put the need, based on the millennial population coming through, of about 1.6, and we're currently running at 1.1 million. So we're at a top of 2 million pre-GFC, and then it went down to about 500,000, and we've had a recovery, but it still hasn't come back to the long-term average. In addition to that, you've got a number of tailwinds blowing behind the industry. The millennial population, so if you look at the 35 to 44 year age bracket of people, which is the key baby having age and buying homes, that's at a cyclical low, and that's about to take off on a 15-year run, which would dramatically increase that age bracket. And if you look at the cost of buying a home in America, it's about 20% cheaper than renting a property in America on average. So the name that we've bought is a company called NVR. It actually went broke in 1992, which is when there was a housing downturn in America. And the company came out and decided that they wanted to stay in this business, but how could they build a business that wasn't vulnerable to bankruptcy with every recession? So what they did was they came up with an idea that instead of buying a huge land bank and having to borrow a heap of money to support it, even though the land bank provides little cash flow, they decided they'd pay up to a 10% premium for the plots of land that would give them the option to develop it at some time in the future once they had a development contract. So that completely changes the financials of the business. And so instead of having this huge amount of debt, it now has next to no net debt and has grown earnings per share at 26% annually for the last 20 years. And the reason it's been able to do that is because it's been able to buy back 77% of its shares on issue over that period. So this is the difference between being highly leveraged and actually having all that free cash flow to buy back shares. The catalyst is that plan A is we want to see much more home building, and we've got those tailwinds that we think are going to start. Well, they've already started in the past few years, but we think when that millennial population comes through, that's when we're going to get the really high demand. And with interest rates being so low, and because it's much cheaper to buy a home than rent one, we think those millennials are actually going to be moving out of their parents' garages and basements and actually buying homes of their own. So it's still very, very affordable, but we need that population to come through, and it's going to be a slow burn. But plan B is that if those tailwinds take a bit longer to work through, then we just know this company has wonderful capital allocation skills and will continue to buy back shares. And so A or B, we believe we'll get the return on our stock.